Hello guys, I welcome you in this wonderful video. There is a simple technique that I want to share with you, and I believe it's going to improve your trading. As you can see here, we have an uptrend because the market is made up of higher highs and higher lows, so it was controlled by the buyers. And we know that in an uptrend, the market is usually made up of impulsive moves controlled by the buyers and then corrective moves controlled by the sellers. And usually for us to have a healthy uptrend, we need to make sure that the impulsive moves are always bigger than the correctives. So the correctives are the one controlled by the sellers, and then the impulsive are the ones controlled by the buyers. So when it happens that the impulsive moves, the moves going up, when it happens that they become smaller than the corrective, then it means that the market is now controlled by the sellers. So for us to still say that the trend is healthy, we need to make sure that the moves or the waves which are controlled by the buyers, in this case, which are the impulsive, we need to make sure that they remain big and they keep on getting bigger and bigger compared to the correctives. So as we can see all the way up there, we have this interesting upward move or this impulsive move, and then we're expecting a corrective wave that was almost at this size, and then another impulsive. But then unfortunately the market didn't give us the next impulsive. Instead, the corrective continued until it reached a level where it is now bigger compared to the previous impulsive itself. So now we can see this corrective is bigger compared to this impulsive. So when we receive a corrective that is bigger than the impulsive, as I said earlier, it necessarily means that now the market is controlled by the sellers. But before you can start opening your selling position, there are a few things that you need to consider. Firstly, you need to make sure that you consider the levels. I know this can be confusing to a lot of people, because when they see such structures, they'll begin to associate them with this kind of lows and highs and say, no, the market is like to reverse here, because even in the near past, the impulsive wave begin at the same level. That's not how this thing usually works. How you should do it is that you should make sure that you only pay attention to the most recent territory of the buyers or those particular players who are controlling the market at this at that particular scenario. For an example, here is the low that we are mostly interested on, because that's where the buyers took the market from. We don't care about that one because it's not that significant. It was significant when the market was at this level. It was significant, but now because the market have made a new territory, that's what we pay attention into. So this is the territory that has to tell us what the market is really about to do. But we can see that already the market has broken this area and it is now below it. It is now below that area. So let me just remove this. So it is already below that territory, meaning it is now telling us that the sellers, they are getting stronger compared to the buyers. But there is one thing that is only left. We need to make sure that the pattern or the patterns that made the uptrend, they are now inverse and they are making a downtrend. What am I talking about? We need to make sure that we now receive another high which is lower than that previous one, because already we have a low which is lower than that previous one, but the pattern is not yet complete, because you need to know that if a market is controlled by the sellers, we have to receive lower lows and lower highs. So what we have here is this: we now have a low that is lower than the previous one, but we have to wait for a low, a high that is lower than that previous one there, because the market can still push all the way up, and if it pushes all the way up, it necessarily means that this that happened here, the lower low that happened here, it is useless because it is not backed by a lower high. So these patterns, they go together, or these waves, they go together. If it's an uptrend, we need to see higher highs and higher lows. If it's a downtrend, we need to see the lower highs and the lower lows. So if we see one, it necessarily means that it's not yet a downtrend, and if you see one even here, it necessarily means that it's not yet an uptrend. So before you make any decision, you need to make sure that these patterns or these waves, they go together. You don't make a decision based on only one conclusion that, hey, the market has broken the low, but how about the high? What about the high? So you have to make sure that you wait for the high to be formed, and then from there it's easy for you to conclude that, hey, the market is reversing. That's why a lot of traders will be challenged by fake breakouts, because they make decisions based only on one high or one low. They don't wait for the pattern to be complete. So in such scenarios, make sure that you wait for the pattern to be complete. Receive a low that is, receive a high that is at least lower than that previous one. Maybe the market is going to go up and reverse here. Then after it reverse here, then you'll know that, hey, the market is now going down. But for now, we just have a single signal that is not stable on its own. So you have to wait for a new high to be formed. So I'm just going to keep it short and leave it here. Thank you guys for watching.